this call here. All right, so the call is now being recorded here. Like I said, today we're going to talk about what it means to read quotes, leverage, talk about leverage, pips, and lot sizes. Okay, let's jump to the information. Let me share my screen. 1 moment. I don't know why I'm acting brand new on here. I'm trying to hide my video here, and I can't. For some reason, my brain is not clicking. There we go. All right. Good morning. Good morning, everyone. Good to see you on here. All right. What's going on? See, we got Pakistan in the building as well, too. Welcome to the call. So, all right, we're going into the mechanics of Forex trading, folks. We're going to do this academic real quick, and then we're going to top in some charts. So, just like we talked about last week, the special thing about the foreign exchange market, I don't think most people realize this is a decentralized global market. The unfortunate part, because it is decentralized, where there is decentralization, okay, there's still going to be manipulation. When we start this crypto thing, people start getting to crypto and we start talking about decentralization. What we recognize today is there's still a lot of manipulation in every market, no matter who it is, right? So because there is oversight, but the Forex market has no physical exchange. It's 24 hours a day. It goes through global networks of banks, financial institutions, and individual traders. But the major folks are your network of banks. They run pretty much the foreign exchange. Why? Because they are the market makers. They are the ones that make currencies move up and down, sideways, and so forth. While we're in between the little small guys and girls trying to get our profits here and there in between what the banks are doing. Okay, currencies are traded in pairs, as we talked about earlier before. The values of individual currencies vary based on the supply and demand. They're traded in pairs like EUR USD, GBP USD, etc. GBP JPY, one of my favorite pairs. Leverage allows trading on margin. So we're going to talk about the power of leverage, because you get to a broker, and instead of having to trade your money, let's say you only have $100 to trade. Well, if they're giving you $100 of margin, it's like trading $10,000. Okay, that's the power of leveraging Forex, and this is why people want to be inside this market. Leverage allows traders to open up much larger positions than their account balance would normally allow them to do. So this is what makes Forex very, very powerful, because if you get very efficient at trading, yes, you can flip some accounts, you can make some money in this industry, especially if you lead with risk management and caution. Okay, you may find yourself to be really good. Okay, when it comes to reading a Forex quote shows the value of one currency compared to another. It's a bid price ending ask price, and we're going to break those down, representing the sell and the buy prices. Okay, the difference between these prices is called the spread. Now, when you have a spread, like you'll hear things like, man, they have a big spread, they have a small spread. The spread is basically what you're going to pay to the broker prior to you making the trade. Okay, so bid price, ask price is going to be based on whether you're buying or selling. And so if you take a bid price and buying, so a bid price and you're buying, there's going to be a spread there that you're going to have to pay before your trade goes into profit. This is why it's very it's significant that you look at what the spreads are, so that if I'm taking a trade, I don't want to start behind the line too much. Okay, I don't want to start behind the line too much if that spread is too big. All right, so if you don't pay attention to that, that can be a nightmare. All right, so bid and ask prices, what are they? The bid price, the price at which the market is willing to buy the base currency for. Remember, we said the base currency is the first currency of the pair. Okay, the ask price is the price at which the market is willing to sell the base currency for. Okay, so ask is to sell, bid is to buy. Very simple. Bid, buy, ask, sell. Okay, and then spread, the difference between the bid and the ask price. What's going to be profited in between the selling and the buyer. That's what the brokers keep. Okay, the base currency is the first currency in the currency pair which is being bought or sold. Okay, and then the quote currency is the second currency in a currency pair used to determine the price. Okay, these are just nomenclature. You can remember this. You can take a picture of it. I'm going to provide the slides at some point as well too in a file here. Buying and selling. You can buy at the ask price and sell at the bid price. Okay, so you buy at the ask price and you sell at the bid price. All right, so here's just a depiction. When you look at the buyer buys at the ask price. Okay, the market, okay, buys at this price. So when buy and ask, that's what the market is selling for. And then we get to this side, okay, now we have to find the seller. So when we're buying, there's someone selling. Okay, so their bid price is this. Okay, you see the 5, subtract it off that, selling back to the market. So the market keeps 0.0005. or we call 5 pips. Okay, so 5 pip spread is pretty significant. I don't know about you. I wouldn't want to get into a trade with a 5 pip spread, depending on the instrument. Now, it may be you see some with 1 pip, 2 pip, 3 pip spreads, but 5 pip is pretty up there. Okay, but this is to understand what's happening. There has to always be a buyer and a seller, and of course, in between that is what the broker is keeping. Okay, now we're breaking down the base and quote currency. Okay, in Forex trading, currency pairs are always quoted in 2 currencies. So the first currency is listed called the base currency, okay? And then the second currency is listed called the quote currency. So the example below, we're going to use GBP, JPY as the currency pair. So when we look at GBP, the first pair of this, it's considered what we call the base pair. This represents how much of the quote pair, so this side, how much of JPY, okay, how much of the quote currency is needed for 1 unit of the base currency. So what we're doing is how many units of this is needed to exchange for this. That's all that we're doing in the market. When we're buying and selling, we're just making exchange between each of the pairs. Okay, we're saying, okay, I think that the British pound is going to go up in value, and therefore, because the British pound goes up in value, okay, JPY goes down in value or has cost more to buy GBP, JPY, and so forth. Okay, used to measure the value. So the quote currency is used to measure the value of the base currency. All right, so the exchange rate. All right, understanding leverage. When we hop into leverage, the reason that we can even trade in the foreign exchange market is because of leverage that brokers are giving, for example, okay? If you are in the United States with any regulated broker, I believe the max leverage they're going to give you, I believe, is a 1 to 50. Okay, what that means is for every dollar that you deposit into that broker, it's going to be like trading $50, or they're giving you $50 of leverage for that dollar. Okay, so leverage allows traders to control larger positions with less capital by borrowing money from the broker. All right, the leverage ratio determines how much capital is needed to open a position. Right, so if that broker says, well, we only do standard positions, or we only do down to a micro position, okay, there's going to be a certain amount that you have to have. We're going to talk about those different type of lot sizes here coming up in the next couple of slides. Okay, margin is the amount of capital required to open a leverage position based on leverage ratio. So the amount of money inside your account. All right, and then what type of positions that you can take. And then the risk. Leverage amplifies potential profits, but also increases risk. Losses can exceed deposits. Now, and depending on your platform, if you're using a broker in the United States like a Charles Schwab or TD Ameritrade or an E-Trade, yes, you can go past what you have in that account. So you must be careful, okay? Or I think you can select that you don't want to use necessarily a margin account. It can be crazy because you can blow past what you have inside of your account using U.S. regulated brokers, okay? Now, if you're using something like an MT4 platform, most time these brokers do not let you go past your deposit. Once you what we call blow your account, the account is gone. There's no money that you owe. You just can create another new account, okay? That's what's called a margin call. Margin call is if the account value drops below margin requirements, okay? So meaning you've now used up more than what you actually have in the account. The broker can issue a margin call, force you to add funds. If you don't add funds, you blow the account, okay? Now, what I say is if you're in a trade and that thing is constantly going down, let the losing trade be the losing trade. Close that account out and they re-enter for a better time. Let's not tell you the lessons I've learned over time as a trader. Never add funds to a losing portfolio or a losing trade, okay? Because just close it out. You're already beyond where you should be at. I can't tell you the heartache I've taken, okay? Because, I'm like, man, because you have so much. Now, mind, you're an amateur, but you have this feeling that this price is going to reverse and go back to your point so that you can get all your money back that you just lost, okay? And ultimately, what you're doing mindset-wise, they got you because this is where they want you at, but you're in a gambling stage of your trading career, okay? You're gambling. You're like, man, I'm betting that the market's going to turn around in this this losing trade that I'm in right now, okay? And so I'm just going to save you the heartache is when you get into trades like that, just close it out. Don't add more money. It's in the wrong direction. And if we can do better, we actually set up a place where we're like, hey, this is where my stop loss is at. Okay, this is where I end this trade session at. Okay. All right, margin explain. Margin is the amount of capital required to open a leverage position in Forex trading. Leverage allows traders to control larger positions than their account balance would normally allow by only requiring a small percentage of the total position size to be held as margin. Okay, this is why you can take a $100 account and flip it to $100 the same day if you wanted to, or in the same week. Okay, obviously you would be over leveraging, but okay, you have the leverage there to do it. Now, what are pips? Okay, a pip is the smallest price move that a given exchange rate can make. For most currency pairs, a pip is a movement in the fourth decimal place. We're going to really go over this. I want you to remember this part. You need to know this part, okay? So a pip is the fourth decimal place unless it's dealing with JPY. And we're going to talk about those two differences because this is going to be how you calculate your pips. Okay, calculating pip value. The value of a pip varies based on the traded currency and lot size. Use the formula value per pip equals pip decimal places divided by rate. Don't worry, we're not have to do all this. I'm going to show you guys the easy way times lot size, okay? And so they're kind of giving you that here on the right, the example of EUR USD. We're actually going to practice this on this call. Monitor pip movements. So pay close attention to pips movements to calculate potential profits and losses for your position. Why do you need to know how to calculate your pips? Because this is going to determine your risk management, what you can trade, right? So if you're saying, hey, I got $1,000 in my account and I only want to risk 3%. Okay, so 3% of 1,000 is $30. So I only want to risk $30. That means that my stop loss has to be placed $30 back. Okay, now let's say that I think I'm gonna need at least 30 pip room, like for my trade, just in case my trade corrects no more than 15 pips. So I need the room so that it doesn't hit my stop loss, and I don't want to risk more than $30. So my max position that I would place into that trade, okay, based on 30 pips as a stop loss, okay, that means $1 per pip, right? And so I'm going to teach you how to calculate this, but $1 per pip will be basically a micro lot size, some 10,000 units. So 0.10. Okay, you'll do a 0.10 lot size. That'll be $1 per pip. Okay, and that's how you determine your lot size based on what you're moving through. This is using proper risk management. We're going to do more examples of that. Use smaller lots initially. Consider using micro or mini lots when starting out to limit pip risk exposure. Right, and most experienced traders use standards, okay, and above. Right, that's been dealing with much larger lot sizes, especially if you're using a prop firm. Most likely you're using, a standard, 5 standard, 10 standard, and so forth. Okay, so pips and stop losses. Use pips values to determine appropriate stop loss placement to control potential losses. Okay, all right, Forex lot sizes. Okay, we're going to get this more in detail. So you can take a picture of this if you like, but a micro lot. Okay, there's a smaller lot as well too, so that you know. The smallest lot is a nano lot. Most brokers don't have nano lots, okay? But a micro lot, okay, this is where trading pretty much starts with your small account. It's based on 1,000 units of currency, okay? So this is the leverage that you're receiving. So when you trade a micro lot, it's basically you trading 1,000 units of that currency, okay? When you trade a mini lot, it's you trading 10,000 units, and a standard lot is you trading 100,000 units, all right? And so here's a quick breakdown of it. You can take a picture of this for your records until you get used to seeing this. So when we talk about a standard lot, this is what everyone wants to get to, a standard lot, okay? That means you're making $10 per pip, okay? So you would put 1, if you're using a MetaTrader 4 as your app, for example, okay? That means you would use a 1, and that 1 would stand for $10 per pip. Okay, and basically what you would be doing is you're trading 100,000 units, okay, of currency. The mini would be 10,000 units, okay? That's $1 per pip you're earning. And so you would see that as a 0.10, okay, in your money space, which would represent $1 per pip. And then your micro lots is you're trading 1,000 units of currency. In this, you would see actually it'll be 10 cents per pip, but it would be in your trading as 0.01. Okay, that is the lowest form. And then of course 1 cent per pip, so 0.001. Now note, it's rarely that brokers allow you to do nano lots. I haven't seen them. Some brokers will come out with it and do nano lots though. Okay, all right, so calculating pips and Forex. Okay, let's get down to it, and then we're gonna hop into what you want to hop into, right? We're gonna get into these charts here. So calculate pips. So let's look at EUR USD. This is a standard currency, the most traded currency in the world, EUR USD. All right, everyone trades it. So EUR USD is the USD. The USD is the quote currency in this, so we're going to be quoted in US dollars. Now, understand when you're using exotic pairs, so any pairs that are normal pairs, or They are attached. Major pairs are considered to be attached to the US dollar. Okay. Your minor pair or exotic pairs are anything other than something attached to the US dollar. All right. And so because the pip is measured in the quote currency, the calculation is straightforward. So we typically you would have to convert to know how much money you're exactly making, but we just keep it simple, measure the pips, just know that your profit will be somewhere around where you expect it to be at. So 1 pip in USD is typically equal to a price movement of 0.0001. Okay, so when you see the quote of this pair, we just need to know what the movement of pips is, up or down. So this is 1 pip. The last number, the fourth number past the decimal is your pip count. Okay, the smallest movement in the foreign exchange. So if this would move up to, let's say 2, that would be 2 pips. All right, so now what I want you to do, something to blow some of your minds, because you knew how to calculate pip, but you didn't know where the number came from. So now remember we said a standard is 100,000 units of currency. So if you take your calculator right now and you place 100,000 in that calculator and you divide it by, you times it times 0.000.0001, you get $10. Okay, anybody got that? So for a standard, it will be $10 per pip. That's what you're seeing. A standard would be $10 per pip based on this. So if we were doing a standard, now if we were doing a mini, which is 10,000 units of currency, then what we do, we would take 10,000 units, that's what we're moving when we do a mini, times the pip movement, which is only 1 pip, times 0.0001, and that equals 1. So that gives us our 1. That's $1 per pip. So this is how we actually find the number that we're doing, okay? So for example, if the EUR USD moves from 1.2050 to 1.2051, that's a 1 pip movement up, okay? That's $1 US, okay, in price movement based on if we did a mini lot, right? So if we're trading a standard lot, like we said before, 100 units of currency, a 1 pip move would be worth $10. The calculation is 0.001 times 100. Okay, for a mini lot, same thing. We're moving 10,000 units of currency. Okay, that's 1 pip move would be worth $1. Okay, the calculation will be 0.001 times 10,000. And then you have a micro lot, the smallest lot. Well, not the smallest lot, but pretty much the smallest lot that most brokers use. So 1 pip move would only be 10 cents per movement. So if you did micro lots, you would for every 10 pips, you would make $1. Okay. If you did a mini lot, for every 10 pips you would make $10. And if you use a standard lot, for every 10 pips of movement, you would make $100. Okay. And so 10 pips happen fast depending on what type of financial instruments you're using. You know, like I said before, if you're using US 30, that happens very, very fast. Okay. You can see $500, $1,000, $2,000 happen on your chart in either direction very, very fast. Okay. So as long as you know where price is going, you can win significantly in the market. If you don't know where price is going, you can hurt yourself significantly inside the market, okay? And especially if you don't have the confidence to trade in the market, okay? Now look at another example. This is dealing with the yen, okay? Yens are calculated much differently. Why? Because it actually only has 3 numbers that follow the decimal compared to 4 numbers. Remember, with 4 numbers, the USD, okay, the last decimal was the pip. In the yen, okay, the middle number, the second number from the decimal is considered the first pip, okay? And so for GBP is a pair where the yen is the quote currency. The JPY pairs are quoted with 2 decimal places, so a pip typically equals a price movement of 0.01. Now, there's a number behind that as well, too. It typically shows that, right? So, for example, if GBP JPY moves from 150.000 to 150.100, that's a 0.100, okay, rise, which is a value of 10 pips. Now, if it was let's say we didn't have the 1 here and the 1 was here, this would only be a 1 pip move. So for anything that's attached to the JPY, okay, the pip movement, the 1 pip movement and up, okay, so from here, so from that second, where is my, lost my mouse here. Where you go? Give me 1 second. I just lost my mouse. Where you go? Okay. Well, we can go from where I'm reading that. I don't know where my mouse went, folks. I apologize. Let me see if I get it back. Let me slow it down. Holy, I lost my mouse, y'all. Okay. All right. So, anyways, I'm on the third line here. So it's a tip pip move, and the second number past the decimal will be your pip movement. Okay. So let's calculate the value of pips for JPY. Man, I hate that I don't. Let me do it. There we go. We got it back. You know what it is? I lost my, give me 1 second. Let me get my other pad here. There we go. My first one died on me, but I got to back up. All right, so here we go. So like I said before, so here's what I'm talking about. This second one would actually be your pip number. So this can go from 1 all the way to 9, okay? And that would be 9 pips if a 9 was there and not a 1 there. All right, so now let's do our calculations. If you're trading a standard lot, 100,000 units of currency, a 1 pip move would be worth 1,000 yen, okay? Now we just keep it simple. Yes, the money will be off a little bit, okay, but for the most part, to keep it simple, it's going to be somewhat the same, okay. But yeah, it will be off a little bit, but the same way you calculate the same exact way. Now there is a conversion to convert this to US dollars. You would divide the USD JPY exchange rate, okay. That's a whole nother currency pair, okay, which is if it was trading at 110, for example, you would calculate 1,000 divided by 110, which would be approximately 9.90 USD. And this will be what you would get paid in yen or get paid in US dollar based on your yen movement. So I'll say you don't have to worry about that. The biggest part I want you to get from this, how to calculate your pips, okay? How many pips are you getting per movement? That's what I want you to be able to calculate on this call. All right. So let's do some practice here. I'll just ask you in the chat. I know some of you will be very slow with it, but I want to see if you get it. Because if you don't get it, I want to go over it a little bit more because this is important. So we're going to do a practice. We're doing a buy setup, for example, for EUR USD. Our entry point is 1.2000. Okay. And so what would be our fourth after the fourth decimal would be what? Our pip count, right? So if we're buying, we're expecting price to increase. Let's say our price does increase and we take profit, okay, at 1.2025, which we exit the trade. All right. So how many pips did I gain with this buy? Does anybody know? Okay, Henry says 25 pips. Is he correct? What else? Is he correct? Come on, let me get. I at least need to get a third of you participating. Show me that you're learning. Okay, 25. Is that correct? 25. I like it. Okay, we got some agreement. 25. Okay, that's correct. It's 25. Yes, it's correct. So the pip count went up and it counted all the way up. It's 25. So this would be 25 pips. All right. And so wonder if this went all the way and this was a 1 here. Okay. Yes, that would be 100 pips. So the more it counts up, if you went all the way up and that changed, let's say this went from here to 3,025, that would be 1,000 pips. Okay. So that's how we count our pips here. Okay. All right. So now looking at another one, this is a trick one. GBP JPY. It's a sale. All right. Price starts at 150.500. We take profit at 150.3350. Henry says 15 pips. Is he correct? Yes. Now, I know that people are putting this on here. If you don't understand what you're seeing, please send me a message saying, I don't get it. Okay. But let me just break down why they're getting that. So remember, for the yen, JPYs, the pip count is in a different place. It's not the fourth decimal because there isn't one there, but it's actually the second decimal is where we count our pips at. Okay. So in this one, we were selling, so we expect the price to go down and price decrease by 15 pips. So it went from 50 to 35. That's 15 pips. All right. All right, so let's do another one. This one is a sell for AUD CAD. Entry price was 0.9500. Okay, exit of 9470. I did this a little trick a little bit. Okay, so what is the pip count? All right, so we got Henry says 30. Is he correct? Yes, he's correct. 30 pips. That is correct. Okay, yes, 30 pips. Okay, so we got this down. Now, what I want you guys to do, if you don't understand this, please send me a message that you don't understand this. We'll go over a little bit more, but this is very important for you to know. You need to know what you're making and what you're risking every time that you go into a trade, okay? Because it should determine the lot size that you're going to use when you're calculating your pips. If you don't know how to calculate pips, then it's impossible for you to actually apply risk management to your portfolio or to you trading. So this is why this is important here, okay? Awesome. Looks like you guys got this down. Did I miss lot? Did I talk about lot size? Did I miss lot sizes? I guess we kind of lumped those in, didn't we? I thought I had more content about lot size, but I think that's it. So here's what we're going to do. We're going to go ahead and go into some charting here. One moment. All right, folks, if you already received some value, drop some 1-1s in the chat. We're going to get on these charts now, and we're going to break some stuff down. I know that I'm going to look in the group and see what you guys have here. Give me 1 second. Let me see. Let me get my mouse back, see if this one works. There we go. We got this back. All right, we are in there. Okay. So we use Trading View. Now I see a lot of your charts get marked up. Like you guys did very, very good. Let's see it. Okay, Jonathan, I'll make sure I'll give this recording to you as well too. All right. All right, we'll go. You know what? Let's go and let's do some more. Let's do it on the real. Let's do it on the real. Let's do pip calculation on the real charts here. Actually. Oh, man. Got protect your account in all things. So two-factor authenticator. Gotta have it on here. So you can do what you can do on here is you can do sell and buy setups on here as well too. And so that's what you heard. I think I had a sell setup here. Let me see if I can find it. It's not showing my charts marked up. I surely marked up these charts yesterday. It looks like it's not showing any of them. Let me see if I can bring out a saved list. All right, looks like we'll be marking up some charts together here. Okay, so here's what we'll do. Let me cut off the recording here.